One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights. This is the only show dedicated to helping you learn both the technical and non-technical aspects of the investment banking process. Hello, my name is Alex Mason, and I'm so grateful that you're here. Today, we're going to be doing an accounting problem and just simply how are the three financial statements affected if a company sells a product for $20 that cost them $10 to make. So let's now go to the whiteboard and walk through this scenario and what we need to look at. Okay, so as usual, we're going to list out the three financial statements. We got our income statement, we got our cash flow statement, and we have our balance sheet. Now, when a company makes a sale, first things first, income statement, super fundamental, they get revenue, right? Revenue. So that's the top line. So your revenue in this case, we're going to assume it goes up by $20 because that's what we sold the product for. Now let's also say that it costs us $10 to make it. So cost of goods sold goes up by $10. Remember, this is an expense. And then you also have your operating expenses. We're assuming no change there. So if we subtract our cost of goods sold from our revenue, our operating profit, or our EBIT, is going to go up by $10. 20 minus 10 equals 10. Okay? So now let's go ahead and assume a 40% tax rate on this operating profit. So let's say our taxes are $4. And let's assume no interest expense. So our net income or our profit is going to go up by $6. Okay, so far so good. We sell something for $20, costs us $10 to make. After we account for the impact of taxes, profit has gone up by $6. So remember, our net income flows up to the top of our cash flow statement. Remember, we got cash flow from operations, cash flow from investing, cash flow from financing. So focus on cash flow from operations. We start out with net income, and we're up by 6. And remember that we have the expense of inventory. So if it costs us $10 to make this product, then we want to account for that as well. So another thing about the cash flow statement, when you're adjusting your cash flow from operations, you have to adjust for changes in what's called working capital. And we'll have an episode specifically talking about working capital in a little while. But for now, I just want to say that because we are consuming inventory in the business to result in a sale, we account for that here in the cash flow from operations section. So our inventory or our cost of goods sold in this case is going to be accounted for here. So change in net working capital goes up by $10. And so our total change here in cash flow from operations is positive $16. Now there are no other changes here to the cash flow statement, either in terms of investing or financing, so we can skip those. So that means our net change in cash goes up by $16. Now, going up to the balance sheet, looking at our assets, since our cash went up, That's an asset, right? So we gained $16 there. After we gain the $16, we also have to account for our inventory going away. Because remember, we sold the product for $20, it cost us $10 to make, and that $10 was inventory. And inventory is an asset. So inventory goes down by $10. So your net change in your assets is a positive $6. Now on the liability side, no changes. And on the equity side, remember our net income flows over to retained earnings, which is a part of equity. So if we take that over here, retained earnings go up by $6, and our balance sheet balances. $6 matches the $6, no change in liabilities there. So that's how you would flow through the three financial statements if a company made $20 in terms of revenue for the sale of a product, but it only cost them $10 to make. So that's what we got for you today here on Investment Banking Insights. Thank you so much for joining me, for watching, listening, wherever you're finding this. I appreciate you, and I'll see you on the next one. All right, bye-bye.